I'm sorry, I know. It's the day after Christmas. It's December 26th. You're probably still surrounded by wrapping paper, trying to finish off the leftovers and looking forward to a quiet week before New Year's. I wanted that too, I really did. I was sitting there with my family trying to ignore the terminal for just 24 hours. But I wouldn't be turning this camera back on right now if it was not an absolute emergency. I need you to put down the coffee for 10 minutes and look at the hard data that just crossed my desk from the other side of the world. The silver market just suffered a catastrophic physical fracture while the West was opening presents. This isn't a correction or a dip. This is a total systemic collapse of price discovery. Ladies and gentlemen, look at the number I'm putting on the screen right now. $90.04. This is not a typo. This is not a what-if scenario. This is the real, verified settlement price of physical silver in Shanghai right now. Specifically, the premium on the SGE has just exploded to levels we've never seen in history. Now, look at your Western broker app. Look at the COMEX price in New York, $72 or dollars. Do you see the problem? That is an $18.04 gap. In 20 years of trading, I have never, not once, seen a disconnect this violent. In the professional world, we don't call this a spread. We call this a broken market. I know the skeptics are already watching. I know the trolls are typing, Asian guy, you're making up numbers. So let's do the math together. Get your calculator out. I'm using the official physical settlement data and the current USD CNY exchange rate. Step 1, take the Shanghai price in yuan per kilogram. Step 2, convert it to US dollars using the current rate of 7.01. That gives us roughly $2,195 per kilo. Step 3, convert those kilograms to troy ounces. Remember, there are 32.15 ounces in a kilo. Step 4, $2,095 divided by 32.15 equals $90.04 per ounce. The math is undeniable. The largest manufacturing engine on Earth, the people who actually need silver to build solar panels and EVs, is valuing the metal at 90. Meanwhile, the paper market in New York, where bankers trade digital promises, is pretending the price is $72. Now, why is this terrifying for the banks? Because in a healthy market, this gap shouldn't exist. If silver is $18 cheaper in New York, every bank and hedge fund on the planet should be buying in New York, flying the metal to Shanghai, and selling it for a risk-free $18,000 profit on every single bar. This is called arbitrage. It's the gravity that keeps global prices together. Usually the spread is 50 cents, but 18. That means the gravity is turned off. It means the arbitrage mechanism is dead. Why aren't the banks closing this gap? Why aren't they buying the cheap silver in New York? There's only one logical explanation. They can't. They can't move the metal because the metal in the Western vaults isn't there to be moved, or the logistics chain has completely buckled under the weight of Eastern demand. We are looking at a market where the paper price and the physical reality have officially filed for divorce. And this brings us to why I interrupted your Boxing Day. Tomorrow morning, the US markets reopen for Ghost Week, those low-volume, illiquid days between Christmas and New Year's. You have a market with zero liquidity in New York and an 18 vacuum pulling the price higher toward China. Nature abhors a vacuum. That gap must close. And since China isn't going to lower their price while they are in a physical shortage, New York has to rise. We are staring down the barrel of a massive gap up when the algorithms wake up and realize how dangerously mispriced they are. I'm going to explain exactly why this premium exploded. I have reports on the specific industrial sectors in China, solar and EV, that are panic hoarding metal regardless of the price. Why are they willing to pay $18 above the global spot price? Why aren't they waiting? Because for a factory floor, the alternative to $90 silver isn't cheaper silver. The alternative is zero. If they don't get the metal, the lines stop and the company dies. We are witnessing an industrial run on the banks, and the West is about to realize the vaults are empty. To truly understand the gravity of what we're seeing, we have to pull back the curtain on how a global price is actually maintained, and why the current $18 fracture is the financial equivalent of a nuclear meltdown. In a functioning world, silver shouldn't have two prices. In a healthy, honest market, the price you see on your screen in Chicago or London should be within pennies of the price in Shanghai or Tokyo. This is maintained by a process called arbitrage. Think of it like a global leveling mechanism. If a gallon of milk cost $3 on one side of a street and $8 on the other, someone would immediately buy all the free milk, walk across the street, and sell it for $7.99. They would keep doing that until the supply on the cheap side vanished and the demand on the expensive side was met, forcing the prices to meet in the middle. In the silver market, the big banks, the JP Morgans and the HSBCs of the world, are the ones who usually play this game. They have the ships, the security teams, and the vaults. Usually, if the Shanghai price drifts even 40 cents above the New York price, these institutions move millions of ounces across the ocean to pocket that tiny, risk-free profit. That constant flow of metal acts like the glue holding the global system together. But right now, that glue has dissolved. When you see an $18 gap, the market is not just volatile. It is screaming that the leveling mechanism has suffered a total mechanical failure. A gap of $18 isn't a spread. It's a mathematical impossibility in a world where silver actually exists in the vaults. If the banks could move the metal to capture that $18 profit, they would be doing it every second of every hour. The fact that the gap is widening instead of closing tells us the most terrifying secret in the bullion world. The purest milk on the cheap side of the street does not actually exist. The $72 price we see on the COMEX is a ghost. It is a hallucination maintained by a system of paper contracts that have lost all connection to the physical earth. To understand how they've kept this lie going for so long, you have to look at the paper lie. For decades, the Western price of silver hasn't been determined by how much metal is pulled out of the ground. It's been determined by how much ink is printed on a contract. On the COMEX, for every 1 ounce of physical silver sitting in a vault, there are often 100, 300, or even 500 ounces of paper silver being traded. It's a massive game of musical chairs. The banks sell these paper promises to each other to keep the price suppressed because a low silver price makes the US dollar look strong. It is a highly leveraged shell game where they assume that nobody will ever show up at the vault door and say, "I don't want your digital credits, I want my bars." As long as everyone plays along and accepts a cash settlement, the banks can pretend the price is $72. They can print an infinite amount of paper to short the market and drive the price down whenever physical demand starts to spike. But China has just stopped playing. They've stopped looking at the paper and started looking at the bars. This brings us to the most damning evidence of all, the state of the Western vaults. If you look at the images of the COMEX vaults in the thumbnail, you see the massive steel doors, but what's behind them is the real story. In the bullion world, we track 2 categories of silver, eligible and registered. Eligible silver is just metal sitting in a vault that belongs to someone else. It's not for sale. Registered silver is the only stuff available to satisfy a delivery request on a futures contract. This is the war chest. Over the last several months, we have watched a systematic, relentless drain of this registered silver. Millions of ounces are being deregistered and moved out of the system every single week. It is a slow-motion bank run that has now reached a fever pitch. When you see the no silver available sign flashing in our analysis, it's because the ratio of paper claims to physical bars has reached a breaking point. Imagine a stadium with 50,000 people holding guaranteed seating tickets, but when the gates open, there are only 500 chairs on the field. That is the COMEX right now. As long as the lights are off and the music is playing, everyone feels wealthy. But the $90 price in China is the equivalent of the lights being flipped on. The people in the East have realized there aren't enough chairs, so they are bidding the price of the existing chairs into the stratosphere. They are paying the $18 premium because they know that once the registered category hits 0, the price won't just move up, it will vanish. There will be no price because there will be no metal. This 18 signal is the canary in the coal mine for the death of the Western price-setting power. For the last century, New York and London told the world what silver was worth. They used their massive paper leverage to bully the market and keep the price in a tight box. But the industrial reality of the 21st century, the solar panels, the high-tech weaponry, the electric vehicle grids, doesn't run on paper. It runs on atoms. China, being the world's factory, needs those atoms more than they need the approval of Western bankers. By paying $90, they are effectively telling the COMEX, your paper is worthless. We are setting a new floor based on physical reality. When you visualize the drain, don't just think of bars moving from one room to another. Think of wealth moving from the west to the east. Every ounce that leaves a London or New York vault to chase that $90 price in Shanghai is an ounce that is never coming back. We are witnessing the largest transfer of strategic metal in history, and it is happening because the West is too arrogant to realize that you cannot print silver out of thin air. The leverage trap has snapped shut. The banks are sitting on massive short positions at $72, thinking they can just paper over the demand like they did in 2011 or 2020. But you can't paper over a physical shortage. As we move into this ghost week of trading, the lack of liquidity means that even a small attempt to close this 18 gap could result in a vertical price spike. The paper lie is being exposed by the harsh light of Eastern physical demand. We are at the point where the people holding the paper promises are going to realize they are holding a contract for a bar that has already been loaded onto a ship headed for Shanghai. The vaults are being hollowed out, the leverage is exploding, and the 18 gap is the final warning shot before the entire system revalues silver at its true physical worth. The arbitrage is broken because the metal is gone. And if the metal is gone, the $72 price is nothing more than a memory. To truly grasp why that $18 gap exists, you have to understand that the buyer on the other side of the world is not a retail trader sitting in a basement chasing a chart. The cruising out of the whale, paying $98 an ounce in Shanghai, is a massive industrial complex that has reached a point of absolute desperation. We'd be talking about the backbone of the Chinese economy, the solar panel gigafactories and the electric vehicle assembly lines that have been tasked by the central government to lead the green revolution. For these giants, silver isn't just a precious metal or a speculative asset. It is a critical industrial raw material, no different than electricity or water. If they don't have it, the machines stop. And right now, the silver market in China has transformed into an industrial vacuum that is sucking up every available physical ounce on the planet. The primary driver of this vacuum is the solar photovoltaic sector. For years, Western analysts and experts told us not to worry about silver demand. They claimed the solar industry would simply thrift it away. They told us that engineers would find a way to use copper or aluminum, or simply use less silver paste on each cell, but that narrative just hit a brick wall. We are seeing reports from the China Photovoltaic Industry Association that show silver consumption per watt has officially stopped falling. They have reached the physical limits of chemistry. You cannot conduct electricity across a solar cell with the same efficiency using anything else. As China ramps up to install record-breaking amounts of solar capacity, these factories have realized they are in a race against time. They aren't buying silver at $90 because they want to flip it for a profit. They're buying it because they have billion-dollar contracts to deliver panels. And if they miss those deadlines because they lacked a few thousand ounces of silver paste, the company dies. When the choice is between paying an $18 premium or shutting down a factory that employs 10,000 people, you pay the $18. You pay whatever it takes. This is price insensitivity in its purest, most terrifying form. But it doesn't stop with solar. The electric vehicle race has added a second, even more powerful motor to this vacuum. Every high-end EV produced in China today is a silver sponge. It's in the touchscreens, the autonomous driving sensors, the battery management systems, and increasingly in the silver zinc battery chemistries that are being developed to compete with lithium-ion. As China dominates the global EV market, their demand for silver has become a matter of national security. They aren't looking at the COMEX price and waiting for a dip. They are looking at their production schedules for 2026 and 2027 and realizing that if they don't secure the physical metal now, they won't have it at all. This is a shift from just-in-time inventory to just-in-case stockpiling. The massive premiums we are seeing are the result of commercial hedging accounts, the actual factory owners, panic buying to ensure they aren't the ones left standing when the music stops. While the factories are desperate for the metal, there's a much larger, more strategic move happening behind the scenes. The Chinese Communist Party has been watching the weaponization of the US dollar very closely. They've seen what happened to frozen reserves in global conflicts, and they made a calculated decision. Move the nation's wealth out of Western paper promises and into hard, physical commodities. They are trading their depreciating US treasuries for silver, gold, and copper. They are effectively converting digital digits on a screen into heavy bars in a vault. By allowing and even encouraging these massive premiums in Shanghai, the CCP is facilitating a massive wealth transfer. They are signaling to the world that they no longer value the spot price, dictated by New York bankers. They are creating a new Eastern-centric commodity market, where the price is set by the people who actually consume the goods, not the people who trade the derivatives. This leads to the most important distinction you need to make today. The East isn't speculating, they're consuming. When you see a spike in the price of Bitcoin or a high-flying tech stock, it's usually driven by hot money looking for a quick exit. People buy it, hoping to sell it to someone else at a higher price next week. That is not what is happening in the silver market in China. Once a bar of silver enters a Chinese solar factory, it is dissolved into paste and baked onto a silicon wafer. It is gone. It is taken off the market forever. It isn't coming back to a vault in London to be traded again. This is a permanent destruction of supply. The Western papers market is still priced as if all the silver ever mined is sitting in a vault somewhere, ready to be traded. They don't realize that the industrial vacuum has already swallowed the float. The scale of this vacuum is almost impossible to overstate. We are looking at a country that controls over 80% of the global solar supply chain and a massive portion of the electronics market. When that country decides that silver is a strategic priority, the rest of the world has a major problem. The $90 price is a message to the West. It's China saying, we know how much this metal is actually worth to the future of energy, and we are willing to pay it. They are laughing at the 72 price on the COMEX because they know it is a fiction maintained by banks that don't have the metal to deliver. You have to ask yourself, if the smart money in China, the industrial giants and the sovereign wealth funds, is willing to pay $90 an ounce right now, why are you being told $72 is expensive? The reality is that the 72 price is a subsidized discount provided by Western bullion banks who are trapped in their own short positions. But that subsidy is ending. The industrial vacuum is now so strong that it is pulling metal out of the COMEX vaults at record speeds, and as that metal crosses the ocean, it instantly revalues to the $90 reality. The squeeze isn't a theory, it's a physical necessity. The East has realized that in a world of infinite paper money, the only thing that truly matters is what you can hold in your hand and use in your machines. They are choosing the metal, and they are choosing it at any cost. While the industrial vacuum in the East is pulling the metal, we need to look at exactly where that silver is coming from, and that leads us directly to the smoking gun inside the Western vault system. If you want to see the crime scene of the global financial system, you don't look at the price tickers. You look at the inventory reports from the COMEX warehouses in New York and the LBMA vaults in London. The data we are seeing right now is nothing short of an inventory alert of historic proportions. We are watching a relentless daily drain of physical metal from the biggest names in the business: JP Morgan, Brink's, HSBC, and Manfra, Tordella, and Brooks. Millions upon millions of ounces are being withdrawn and moved out of depository. This isn't just a routine transfer. This is a systematic hollowing out of the West's strategic reserves. When we see silver leaving the registered category, the metal that is actually available to be delivered against futures contracts, and moving into eligible, or simply disappearing off the books entirely, it's a signal that the big players are heading for the exits. They are securing their physical metal because they know that the 72 paper price is a lie that can no longer be sustained. To understand why this drain is fatal, you have to understand the rehypothecation trap. This is the dirty secret of the bullion banking world. For decades, the banks have operated on the assumption that only a tiny fraction of silver investors will ever ask for their physical bars. This allowed them to sell the same ounce of silver to 10, 20, or even 100 different people at the same time. It's a game of fractional reserve silver. You buy a paper ounce of silver on an exchange, and you get a digital statement saying you own it. But in reality, that same bar, sitting in a vault in Manhattan, has 10 different names written on it in invisible ink. As long as the market is quiet, the banks can collect fees and pretend everyone is covered. This rehypothecation, the lending and relending of the same physical asset, is what has allowed the paper price to stay so low for so long. They've effectively created a massive artificial supply of silver that doesn't exist in the physical world. But now, the $18 premium in China has acted like a giant magnet, and it is pulling those bars out of the vault. When one person actually takes delivery of their bar and ships it to Shanghai to pocket that $90 price, the other 9 people who thought they owned that same bar are suddenly holding nothing but a piece of paper. This trap is why we are starting to see the "seeing no silver available" signs flashing across the wholesale market. If you are a small retail investor buying a 1-ounce coin, you might not see it yet because the premiums are just high. This brings us to the ultimate turning point, the moment of systemic default. We are approaching a force majeure event. In the fine print of almost every paper silver contract, there's a clause that says if the exchange cannot find the physical metal to satisfy a delivery request, they can just hand you a check for the cash value instead. This is the moment the paper holders realize they've been scammed. If you held a contract for silver at $72 because you wanted the metal for your solar factory or your long-term wealth protection, and the exchange says, "Sorry, we don't have your silver, here's your $72 back," you have lost. Because the moment you take that cash and try to go buy silver on the open market, you realize the real price is $90, $100, or $150. Your paper contract didn't protect you. It just gave the bank a way to exit their losing bet at your expense. The smoking gun is that this pivot is happening right now. We are seeing a record number of exchange for physical, or EFP transactions, which is a fancy way of saying people are moving their bets off the rigged paper exchanges and into the physical world as fast as they can. The volume of silver moving through these back channels is staggering. It tells us that the smart money has already identified the default. They see the empty shelves at the COMEX. They see the lines forming at the Shanghai Gold Exchange. They know that the 100-to-1 leverage ratio is a ticking time bomb. When the mainstream media finally picks up on the fact that the vaults are empty, the squeeze won't be a slow climb, it will be a vertical moonshot. You have to realize that the silver market is tiny compared to the trillions of dollars floating around in the global bond and stock markets. It doesn't take much to break it, when even 1% of the people holding paper promises suddenly decide they want the real thing. The system collapses instantly. We are watching that 1% make their move right now on December 26th, while the rest of the world is distracted by holiday sales. The millions of ounces leaving JP Morgan and Brink's aren't just numbers on a spreadsheet. They are the lifeblood of the Western financial illusion being drained away. Once that blood is gone, the $72 price dies with it. The default isn't coming. It is being written into the ledger every time a bar is deregistered and shipped east. The no silver available sign is the only honest piece of data left in the West. To understand the sheer explosive potential of this $18 gap, we have to look at the mechanics of the short trap that has currently ensnared the world's largest bullion banks. For years, these institutions have operated on the assumption that silver is a bottomless resource that can be suppressed indefinitely through the use of massive short positions. They sell silver they don't own, trillions of dollars in paper contracts, to drive the price lower, profiting as the market dips. But there's a fatal flaw in this strategy. Every short position is a guaranteed future purchase. Every contract they sold at $30, $50, or $70 must eventually be bought back to close the books. Usually, the banks can manage this by shaking out weak hands and forcing the price down to buy back cheap. But China just changed the rules. As the physical price in the East nears $90, these banks are staring at catastrophic multi-billion-dollar losses. They are trapped. When the price begins to move toward the $90 reality, these banks won't just be watching the market. They will be forced to become the biggest buyers in history. This creates a lethal feedback loop. As they buy to cover their shorts, they drive the price higher, which triggers more margin calls, forcing more buying. The very people who suppressed the price for decades are about to become the jet fuel for its moonshot. This brings us to the gap-up scenario that is looming over the Western markets as we sit here on December 26th. While we have been enjoying the holiday, the ghost of reality has been haunting the global order. When the US markets reopen and the algorithms, the high-frequency trading bots that run 90% of the volume, wake up and look at the Shanghai data, they are going to see a broken gravity signal. These programs are designed to eliminate arbitrage gaps. When an algorithm sees silver at $72 in New York and $90 in Shanghai, it doesn't think, it reacts. It will attempt to buy every available ounce in New York to bridge that $18 chasm. But, as we've already discussed, there is no physical metal left to buy. When the buy orders hit a market with no sell side, the price doesn't just tick up a few cents at a time. It gaps. We are looking at a Monday morning where the ticker could open $5, $10, or even $15 higher than it closed. This isn't just a price move, it's a violent repricing of reality. It's the sound of the paper ceiling finally shattering. Once that gap occurs, the FOMO psychology of the retail market will take over, and that is when the true stampede begins. For years, the average investor has been told that silver is a dead asset or a boring commodity. They have been lulled into a sense of security by the 25 and 30 price range, but humans are hardwired to chase momentum. When the nightly news starts reporting that silver has jumped $10 in a single session, the largest move in history, the millions of people who have been sitting on the sidelines will suddenly realize they are missing the greatest wealth transfer of their lifetime. The retail investor who was too afraid to buy at $70 will suddenly be desperate to buy at $85 because they were terrified it's going to $150. This is the psychological tipping point where fear of loss is replaced by fear of missing out. You will see lines at local coin shops, websites crashing under the weight of traffic, and a total disappearance of silver from the secondary market. The paper lie only works when people are calm. The moment they panic, the physical reality is the only thing that matters. This leads us into the final, most dangerous stage of the squeeze, the Unobtainium phase. This is the point where price becomes irrelevant because there is simply no supply at any level. We have seen this happen in small-scale meme stocks and in certain industrial niche markets. But we have never seen it happen to a core global commodity like silver. In the Unobtainium phase, you can see a spot price of $100 on your screen, but when you call a dealer to buy a bar, they laugh at you. When you try to settle your COMEX contract in metal, you get a notice of default. This is the stage where the industrial giants, the solar and EV whales we talked about, realize that the market has effectively closed. At this point, silver isn't just expensive, it is unavailable. It moves from the category of a traded asset to a strategic reserve. This is where the price can jump into triple digits in a matter of hours, as the few people who actually hold physical bars refuse to sell at any price, realizing that their silver is now the rarest and most necessary commodity on the planet. The mechanics of this squeeze are built into the very structure of the market. It is a mathematical certainty that an $18 gap cannot be ignored by the global financial system. The banks are the ones who built the trap, and now the East is the one who has sprung it. By paying $90, China has forced the banks into a position where they must either deliver metal they don't have or buy back their paper promises at prices that will bankrupt them. Either way, the paper price must die so the physical price can live. As we move closer to the reopening of the markets, you have to ask yourself, do you want to be the person holding the paper promise or the person holding the metal when it becomes unobtainable? The feedback loop is already starting to hum, and when it reaches full volume, the $72 price will be remembered as the greatest gift the banks ever accidentally gave us. The stampede is coming, the gap is yawning open, and the Unobtainium phase is just one Monday morning away. As we stand on the precipice of this new silver frontier, you have to understand that $90 isn't a ceiling. It is the new floor. For decades, the true value of silver has been suppressed by a layer of digital noise. But once that paper market finally snaps, we are going to see a price discovery phase that will shock the world. Why is $90 just the beginning? Because when a market breaks after 50 years of manipulation, it doesn't just adjust, it overshoots. We are moving into a reality where $100 silver isn't a target, it's a baseline. Once the COMEX is exposed as an empty vault and the banks are forced to stop their short-selling games, silver will finally be valued for what it truly is, the most indispensable metal of the green energy age and the only honest form of money left on the planet. When the paper lie evaporates, the scarcity of physical silver becomes the only metric that matters. There is no more paper supply to dampen the fire. We are looking at a future where silver's true value, measured against the mountain of printed currency in the West, is multiples of where we are today. What we are witnessing is the greatest wealth transfer of our lifetime, and it's moving in one direction, from the paper-heavy West to the physical-heavy East. For the last century, the United States and Europe have dictated the price of the world as assets using financial derivatives and promises to pay. We'd have lived in a world where the person holding the receipt was considered just as wealthy as the person holding the gold or silver. But that era of paper wealth is dying. By paying $90 an ounce while the West pretends it's $72, China has officially declared that the era of Western price setting is over. Power is shifting to the hands of those who actually own the atoms, not the ones who own the digital contracts. The East has been quietly stacking, hollowing out Western vaults, and preparing for this exact moment. When the dust settles, the people who held onto paper promises in New York will be left with worthless receipts, while the people holding physical metal will be the ones holding the keys to the new global economy. So, what is the action plan? How do you protect yourself when the world's most undervalued asset finally decides to catch up to reality? The first step is to stop looking at the $72 ticker on your screen. That number is a ghost. It is a leftover hallucination from a system that is currently defaulting. You need to start looking at the $90 reality in Shanghai. If you're waiting for a dip back to $30 or $40, you are waiting for a world that no longer exists. Every day you spend watching the paper price is a day the window of opportunity is closing. You need to treat silver not as a trade, but as an insurance policy against a broken financial system. Secure your physical position now, before the unobtainium phase makes it impossible to find at any price. When the gap finally closes, and it will close, it won't be because China suddenly decided silver was worth less. It will be because the Western price gapped up in a violent overnight repricing that leaves the majority of investors in the dust. I need you to hear this final warning. The window is closing, and it's closing fast. We are in the final hours of the discount era. The $18 gap we are seeing on this December 26th is a gift of information. It is the market telling you exactly where it is going before it gets there. The banks are trapped, the vaults are empty, and the East has already moved. When the ghost week of trading ends and the full weight of global demand hits the market in the new year, the $72 price will be a memory. Don't be the person who looks back and says, I saw the $18 gap, I heard the warning, but I waited for the paper ticker to tell me it was okay to buy. By the time the ticker tells you it's okay, the price will be $120 and the shelves will be bare. The East isn't speculating. They're consuming the very foundations of the West's reserves. This is the great silver squeeze in real time. The gap is the signal. The math is the proof. And the time to act is before the West wakes up to the $90 reality. Listen, the reality is that 99% of people are going to wake up next week and wonder why their purchasing power just evaporated. You're already ahead of the curve because you're looking at the data, not the headlines. But this is a fast-moving fracture. If you want to stay on the right side of this wealth transfer, hit that subscribe button right now and turn on the notification bell. I am tracking the Shanghai premiums and the COMEX inventory levels every single day to make sure you don't get caught in the paper trap. Don't let the ghost week silence fool you. The real move starts when the New York algorithms wake up to a $90 reality. Join our community of physical stackers in the comments below. Tell me what you're seeing at your local coin shops, and let's prepare for the gap up together. I'm the Asian guy, and I'll see you in the next emergency update.